March 9, 2023, the 16th largest bank in America opened its doors as usual. No queue outside, no panic on the pavement. By sunset, $42 billion was gone. $5 billion an hour, 87 million a minute, and not one person stood in line to collect it. This is the collapse files. Collapse file number 7. Subject, Silicon Valley Bank, Santa Clara, California. Age at death, 40 years. Assets, $209 billion. Clients, half the startups in America. Time from announcement to receivership, less than 48 hours. Cause of death, a group chat. No rogue trader, no forged accounts, no missing billions. Every dollar was exactly where the bank said it was. That is what makes this file different, and that is what should frighten you. 1983. The story goes that two Bank of America veterans sketched the idea over a poker game, a bank for the companies no other bank would touch. Startups. Startups have no revenue, no collateral, and a 9 in 10 chance of dying. Banks hate all three. Silicon Valley Bank built an empire on them. By its own count, nearly half of America's venture-backed tech and life science companies banked there. It held their payroll, their war chests, their founders' mortgages. In the Valley, it wasn't a bank, it was the bank. Then came the pandemic, and the greatest flood of venture money in history. In 2021 alone, American startups raised over $300 billion. A staggering share of it landed in one bank. Silicon Valley Bank's deposits roughly tripled in 2 years. $62 billion, then $124, then $189 billion by the end of 2021. Which created a problem most bankers would kill for: too much cash. A bank cannot just sit on deposits, it has to put them to work. But startups don't borrow, they are drowning in venture money, so the bank went shopping. And it bought the single safest asset on planet Earth. United States government bonds. $91 billion of long-dated treasuries and mortgage securities locked away until maturity, yielding barely more than 1.5%. Chief Executive Greg Becker had been at the bank for 30 years. He had survived the dot-com crash and 2008. By late 2021, his bank's shares traded above $700. The safest assets on Earth, the richest clients on Earth. File both facts, the case turns on them. Here is the first twist in the file. The thing that killed Silicon Valley Bank was not a crime. It was this man doing his job. 2022. Inflation hits 9%. The Federal Reserve raises interest rates from near zero to nearly 5% in barely a year, the most violent tightening in 4 decades. And bonds obey a law as old as banking itself. When rates go up, old bonds lose value. Nobody wants a bond paying 1.5% when the new ones pay 5%. The safest portfolio on Earth was now quietly underwater. By December of 2022, the paper loss on those locked-away bonds had reached $15.1 billion. The bank's entire equity, everything it was actually worth, was about $16 billion. The hole was nearly as big as the bank, and almost nobody noticed. How do you hide a $15 billion hole legally? With 3 words: held to maturity. Accounting rules say that if you promise never to sell a bond, you never have to count its losses. Exhibit A, the bank's own annual report, filed publicly that February. The loss is right there in the fair value tables, in black and white, for anyone who cared to look. A bank worth $1.2 billion wearing a $16 billion suit. Inside the bank, the one job built to catch this sat empty. In April 2022, the chief risk officer stepped down. For roughly 8 months, the exact months the losses exploded, nobody held the job. The board's risk committee met again and again through 2022, a quiet, year-long panic visible afterwards in the proxy filings. A new risk chief finally arrived in January 2023. The clock had weeks left on it. Meanwhile, the other side of the balance sheet had sprung a leak. The same rate hikes froze venture funding. Startups stopped raising money and started burning what they had, which meant draining it out of the bank. Deposits fell all through 2022. The bank was being crushed from both ends, assets sinking, deposits draining. The vice was closing. In early March, the ratings agency Moody's called. A downgrade was coming, possibly a hard one. A downgrade would spook depositors. The bank decided to get ahead of the story. The plan: sell the smaller bond portfolio, take the loss publicly, raise fresh capital to plug the hole, and announce it all in one clean stroke. Goldman Sachs was hired. The date was set: Wednesday, March the 8th. On paper, it might even have worked, except for the worst coincidence in modern banking history. Exhibit B, the mid-quarter update, March 8th, 2023. The bank announces it has sold $21 billion of securities at a $1.8 billion loss and needs to raise $2.25 billion in new capital. The very same day, a bank called Silvergate announced it was shutting down for good. Silvergate, the banker to crypto, killed by the same bond losses. By nightfall, Silicon Valley's group chats had a new topic. So when Silicon Valley Bank said we have taken a loss and need capital, the tech world heard something else entirely. It heard, the bank is in trouble, get out first. Thursday, March 9th, the shares opened and dropped 60%, and then the phones came out. Peter Thiel's Founders Fund advised its portfolio companies to move their money out. Other funds followed within hours. And in Silicon Valley, everyone is in the same group chats. This is what a bank run looks like in the 21st century. No queue around the block, no tellers besieged. A WhatsApp message, a wire form, and 30 seconds on a banking app. Greg Becker got on a call with hundreds of investors that afternoon and asked them to stay calm. In banking, those words worked like a fire alarm. $42 billion left in a single business day, a quarter of the bank's deposits. The largest one-day bank run in American history, executed almost entirely by phone. For scale, the run that killed Washington Mutual in 2008, the biggest bank failure ever, took $16.7 billion, spread over 9 days. Silicon Valley Bank lost 2.5 times that before dinner. At the close of business, the bank's cash balance read negative $958 million. It scrambled to move collateral to the Federal Reserve in time to cover the hole. The wires were too slow. Friday morning, March 10th. The bank told regulators another $100 billion was queued to leave that day. Combined with Thursday, depositors were attempting to withdraw 81% of every dollar the bank held. The regulators did not wait for the weekend. Mid-morning, California time, they walked in and seized the bank in the middle of the trading day, something that almost never happens. Banks die on Friday nights. This one could not survive until lunch. Then came the weekend. Thousands of startups had every dollar there, and deposit insurance stopped at $250,000. Roku admitted nearly $500 million stranded. Across America, payroll was due Monday. Sunday night, the government blinked. Treasury, the Fed, and the FDIC invoked the systemic risk exception. Every depositor would be made whole, insured or not. The same announcement carried a second obituary. New York's Signature Bank had just been seized too. America's second and third largest bank failures, 72 hours apart. And the fire kept moving. 9 days later, Credit Suisse, 167 years old, fell into the arms of its rival, UBS, but that is another file. The tally, Silicon Valley Bank, dead at 40. The cleanup bill, first pegged at roughly $20 billion, paid through levies on every other bank in America, which means eventually by you. 2 weeks later, First Citizens, a family-run bank from North Carolina, bought the remains at a $16.5 billion discount. Its own shares jumped 50% in a day. Someone always eats well at a funeral. Greg Becker had sold $3.6 million of his own stock on February 27th, 9 days before the collapse, through a trading plan filed weeks earlier. Perfectly legal. He told Congress he was sorry. He was never charged with anything. The Federal Reserve's own post-mortem called the failure a textbook case of mismanagement. then admitted its supervisors had seen the risks and moved too slowly. When the bank died, 31 unresolved supervisory warnings were sitting in its file. But file away the detail that matters. The money was never missing, the bonds were real, the government paper was good. This bank was killed by its own depositors at fiber optic speed in less than 48 hours. Every bank on Earth now lives one push notification away from the same death. Case closed.